Hello everyone, welcome to our course on fundamentals of trading. And in the very first lesson of this course, we will talk about the distinction between bid prices and ask prices. So here is the outline for this video. We will start with basic definitions, and then we will move on to explain what is meant by the bid-ask spread. And in the final part of the video, we'll talk about the strategy of buying cheap and selling high, which of course relates to bid and ask prices themselves. And there are thumbnails in the video description, so if you would like to jump ahead to a particular item on the agenda today, feel free to do so. Otherwise, let's get started with the first item we have, which are the basic definitions. So what do we mean by bid and ask prices? Well, a bid price is essentially the maximum price a buyer is willing to pay to buy a particular security, which can be, for example, a stock or a bond or anything, any asset. Conversely, an ask price is the minimum price a seller is willing to pay to sell a security. So I would like to give a more specific example to make the distinction clearer. So let's say you are interested in buying a particular stock, and let's assume that, so I'm just trying to use my pen over here, right? So let's say we are interested in buying a particular stock, and let's say the bid price and the ask price we have are as follows. So let's say $10 and $11. So this is quite a big difference in reality, but for the purposes of this video, that's absolutely fine. So this means that essentially, if you would like to buy the stock, the seller, so the counterparty, is going to ask, they're going to sell it to you for $11, right? And if you want to sell the stock, the buyers are willing to buy it from you for $10, right? So in general, ask prices will always be above bid prices, because as we will explain later on, this is how the dealers or market makers make money. This is how they earn profits, by buying low and selling high, right? So in your case, essentially one way to remember this is that bid is buy and ask is sell, but this is from the counterparty's perspective. So bid is the price the counterparty is willing to pay to buy the stock, and ask is the price, sometimes called offer price as well, is the price they are offering when they want to sell the stock, right? So if you would like to trade, once again, you can buy it for $11, right? Or you can sell it to the other party for $10. Another easy way to remember this is that, let's say you don't know which price applies to you, and we have a pair of prices here, and you want to transact, you want to execute a trade, you will always get the price that you don't like, right? So for example, say you want to buy the stock, right? So you would like to buy it as cheap as possible, right? And in this case, unfortunately, this is not the price that is relevant for you, right? In fact, the price you will be able to buy is 11, because that's what the sellers are asking. Conversely, say you want to sell the stock, right? Now you want to sell it at the highest price possible. So ideally, you would like to sell it for 11, but again, in reality, the price relevant for you is $10, because the buyers are bidding for shares at this price. Okay. Right, let's move on to then the second part of the tutorial today, which is the bid-ask spread. And here I would like to show you a chart, right, which actually consists of ask prices and bid prices, right? So we've got you can think of this like a visualization of a limit order book. So we've got limit ask orders here and limit bid orders at the bottom, right? And remember, the ask prices will be higher than bid prices, because that's what the counterparties want. So they try to buy cheap and sell high, right? So what is the bid-ask spread? Essentially, bid-ask spread is the gap over here. Okay, so if we think that these are dollar figures, essentially the bid-ask spread is $1 here. So it's the difference between the lowest ask price, which is the best ask price available in the market, and the highest bid price, which is again the best bid price available in the market. Sometimes this is also referred to as the top of the book, right? The top of the order book. And bid-ask spread is an important measure of liquidity. Okay, so this is quite important to remember. The more liquid an asset is, the narrower this gap will be, right? So if you think about stocks in competitive markets, let's say the American stock exchanges like New York Stock Exchange and so on, the gap will be pretty small, right? So because they are talking about, especially for large stocks, so the bid-ask spread will be pretty small, because you can think of this as the profit margin of a dealer or market maker, all right? And the higher this gap, the more margin, the more profit they are making out of the trades, right? And that is so a measure of liquidity in the sense that the trade, the difference in these prices, go into their pockets. So the lower it is, the more liquid the asset. So that's the key thing to remember. And this now nicely ties with the final part of the tutorial today, where we will talk about the dealers buy cheap and sell high strategy. We've already hinted how that works, but I would like to just wrap it up over here and give again a specific example, right? Again, let's think about a different stock. Let's say these are the prices available in the market. For example, they might be quoted by a dealer. Okay, so this means that the dealer is willing to buy the stock at $4.1 and they're willing to sell it at $4.4. What does that mean? So like we've learned in the previous slide, the difference between these two prices is the bid-ask spread, right? So this is the profit the dealer makes. So in general, what they will do, they will be buying the shares at this price, 4.1, and they will be selling them at this price. And they pocket in the difference. So they are trying to buy cheap or buy low and sell at a higher price. This is their business model. But from your perspective, this is your round trip transaction cost. So maybe let's spell that out here. Round trip transaction cost. And let me explain what I mean by that. So like I said, the dealer will be making a profit by buying at this price and selling at this price. For you, it will be the opposite, right? Because for you, essentially, if you wanted to buy the stock, so let's say you just want to buy one share. So this is the price that you need to pay, right? 4.4. And let's assume you buy this share and immediately you want to sell it back, right? And now this is the price that you will be getting, right? So you pay, so this is a cash outflow, so it's negative. You pay $4.4 to buy the share, and when you sell it, you get $4.1. So this is a cash inflow. That's why the plus sign, right? So your net position is actually a loss of 30 cents. And this is exactly the amount the dealer makes. So it is a zero-sum game, as you can see, right? And that's why the bid-ask spread is important, and that's why it is as small, it's beneficial to the markets that it's as small as possible, because that means that the dealers, the brokers, they are competing with each other, and that competition would bring the gap down, right? And this can be investors as well, right? So it doesn't always have to be just dealers or market makers, but also the competition between the investors would bring down this gap, which is to the benefit of the investors who trade. Especially if you trade often, if you buy, sell securities often, you would incur lots of these costs, right? So the lower they are, the better for you, for your bottom line. Right, so that's all I want to talk about today on bid prices and ask prices. I hope you've enjoyed the video, and if that's the case, please consider giving us a like and subscribing to our channel. And that's all from us today, and hope to see you in another video. Thank you.